Is it still in the middle of a box range? No trading implications. However, I love trading box ranges. Why? Because we have clean-cut support and resistance. So, okay, isn't that doji in a trading range? Yes, but what's the difference? Where does that doji emerge? The top of the range. Was there immediately preceding trend? Yes. That's a great short sell because the market's confirming a resistance area. What was the little clue we had before the doji? A small real body, right? That's a great trading vehicle. So we're going to focus more on what I call candles in context as we look at applying the candlesticks specifically later in the session. But here you can see the doji. Although these are all doji in a box range, because one of these doji emerged at the top end of the box range, we react to it very differently than we would with the doji in the middle of a trading range. Okay, any questions on doji? We'll take a yes, and then we'll take a break.
I know we look at a chart like, I don't know how many time frames this one is. Say if you squish it, like if you compress it, you get more data into it. So you can draw support and trend lines like like in this case, if you're only looking at probably the right side of the
Tell me when to stop. Right.
So you just see the right side. You could draw a box of range.
The question is, you can draw a box range anywhere. Right. That's not really true. To get a box range, you need at least 2 or 3 highs that are the same, and you need 2 or 3 lows that are the same. So, for example, see? And then you have the lows over here. So what's going to happen is, let me go back here. See, I would view this as a box range like that.
Right.
Okay.
Go back to the last one, the context. Okay. To me, it's easy to read the left side of the chart.
Mm-hmm.
It's the right side of the chart I have trouble reading.
Right.
So on this last spinning top here, if I look at the high, this high looks like it is matching the long white candle.
This one?
Yeah, the last candle,
Mm-hmm.
right side. That high looks like it's matching the long white candle to the left, right there.
Mm-hmm.
Right? So is that a range?
Okay, the question is, with this upper shadow here, it's confirming, okay, so we don't know about this stuff here.
We don't care.
Right, we don't care over there. Right. All right, so whoops. This is like a Picasso. When I'm looking at a chart, I'm not only going to look at 4 or 5 days worth of data. I go back at least 3 months of data. So I wouldn't be looking at just this action. Whoops. I would be looking at this action here. We just wouldn't be looking at this. There's no way I'd be looking at this amount, this little amount. These are daily charts, but it could be an intraday chart. So the question is, she's asking, is this a box range here if we're looking in this area that I made a red box around, and there's no way you should be trading with 5 days worth of data. My default is I usually go like 3 months, or whatever the equivalent is, really about 90 days, 60 to 90 days, or whatever the equivalent is on an intraday basis. Because if you go longer than that, if you have like many, many data points, the candles get really hard to see.
Forex, you're only trading, we're only trading days trades. Most of us are trading day trades.
Okay, intraday.
Right. So, say this is
Actually, let's hold off on questions on intraday because we're going to have a whole section on intraday. Okay? And just hold off on that. Yes?
So regardless of what time frame you're looking at, the last 60 to 90
period. Right. The question is, regardless of the time frame we're looking at, I would have at least 60 to 90 data points. For example, 2 or 3 months on a daily chart, whatever the equivalent is on an intraday chart. Now, the exception with that would be, what happens if, let's say we have 90 days worth of data, and this is our last data point. Why would I have to go back further than 90 days? To get a resistance area. In other words, this is the last part of our 90 days, I would go back further because we don't have where next resistance is going to be. Okay, so that's the exception. Or if there's a daily chart, I might look at a weekly chart. If this is an intraday chart, I might look at a daily chart. Okay. So why don't we take a 5-minute break now, and we'll then move on to shadows. And thanks for the great questions, and we'll be moving on. Okay, we're going to look at shadows now. As important as the real bodies are, shadows are very important. The Japanese say, like the right hand helping the left, so it is with real bodies and shadows. So here we have a candlestick line on the left that closed on the high. Now, if we have an upper shadow that offsets some of the bullish strength, Japanese will say a long upper shadow suppresses the rallying strength. One upper shadow is not that big a deal, okay, except for a couple of candlestick lines. We'll look at hammers and shooting stars, but net, a single candlestick line is not that, a single shadow is not that important. Where they become important is if they're confirming a support or resistance area, because what's happening is if you have a series of long upper shadows right near the same resistance, if the market's strong, what should happen? It should close near the highs, right? If every time it gets to near a resistance area, it pulls back, it's visually showing us, and this is what the candles shine at, visually showing us what's going on between the bulls and the bears, the psychology of the market. The market's rejecting higher levels. So if there's a group of 2 or 3 long upper shadow candles near the same resistance area, I would certainly take notice of it. And this slide happens also to be what's happening with the real bodies. Smaller and smaller, right? Now here we have a couple of black real bodies. When you get our daily newsletter illuminations, you'll see that we have ST, short-term trend. ST, we abbreviate. So in this scenario, we would have, say this, this is the pound. We have these candle lines. The trend would be down. Short-term trend would be down. If we added these lower shadows, the short-term trend would be down neutral, /neutral. They wouldn't be up. They wouldn't even be flat because it's mainly making higher closes. But this mitigates some of the bearishness. Okay, so we always have to look at shadows. So here, for example, we have a series of long lower shadows near the same support area. Time after time after time rejecting lower price levels. Same thing here. In fact, beside these upper shadows, what early indications did we have, even with the first few candle lines? Spinning top, doji, right? Now, during the break, somebody asked me about the spinning top and the doji, and we talked about how I view them the same. And the reason that becomes important is because, remember the rule that we had with the doji as a potential resistance area based on the close? All right. The same thing is true with the spinning top. I don't do this in equities or commodities or interest rates, only in Forex. If we have a small real body, a very small real body, because we view it the same as a doji in Forex, we could make a resistance area. Okay, this is exclusively Forex, so this would be resistance based on a close. If this was an equity, I don't use spinning tops as a resistance area. And some of you may recognize some of these signals. We'll look at this later. A bearish, the black wrapping around the white, a bearish engulfing pattern. There's an evening star variation. And we'll get to all these patterns in a couple of minutes. Yes?
How do you view that spike just to the right of the doji? Do you just disregard that, or is that...
Over here, this right here, the spike?
Well, the one to the left of it, but either one of them.
Okay, I'm not... So we have a resistance area. The question is, how do we look at the spike? And this spike?
Either that spike
Or the one before it. Okay. The question is, how do we view these spikes above the resistance area? And the answer is, did it close above resistance? No. So that doji is still